And finally, Dr. Devon Herrick, a PhD, Senior Fellow, National Center for Policy Analysis.
Mr. Chairman, Ranking Member...
Can you pull that right up there?
I sure can.
Thank you.
Mr. Chairman, Ranking Member Hutchison, and members of the committee, I am Devon Herrick, Senior Fellow with the National Center for Policy Analysis. I welcome the opportunity to share my views and look forward to your questions. Between 1 and 2 million Americans currently have a health plan that features limited benefits, sometimes called mini-med plans. Mini-med plans are increasingly popular among low-income workers, seasonal and part-time employees, and firms too small to be able to afford generous health plans. The typical design of a mini-med plan includes coverage for a select number of physician visits, ancillary tests, a limited number of inpatient hospital days, and prescription drugs. The deductibles and co-payments tend to be pretty low, and the maximum amount of medical benefits that can be claimed in any given year is capped anywhere from a few $1,000s, in some cases to $25,000, maybe even $50,000 annually. Mini-med plans are affordable. Premiums for single coverage can start out as low as $250 per year for single coverage, or for family coverage, in some cases as low as $1,000 a year. But one reason that mini-med plans are affordable is because of the amount of risk that the insurance company is underwriting is lower than for a comprehensive plan and is capped at a predetermined level. However, the Affordable Care Act, the new health care reform law, prevents insurers from capping annual limits at less than $750,000 this year, and that phases out completely in 2014. By design, a limited benefit plan cannot meet these requirements and remain affordable. Without waivers, mini-med plans would essentially be banned from the marketplace. Another threat to the existence of mini-med plans is the medical loss ratio regulations, requiring insurers to spend 80% of insurance premiums on medical care. The nature of mini-med plans is such that with the marketing and the administrative cost of plans, especially in industries that have a higher worker turnover, it's hard to meet these regulations. Public health advocates often deride mini-med plans as inadequate, but I believe this is misguided. In any given year, most people who are covered by health insurance experience very low claims. For example, per capita annual medical expenditure does not surpass $3,000 a year until you approach age 50 on average. About half the population spends less than $1,000 a year on medical care. In fact, about 80% of the population will have annual medical expenditures of less than $4,000 in any given year. High medical spending tends to be concentrated among older individuals. Some critics of mini-med plans assume that mini-meds are really the result of stingy employers, but this is really not the case. Economists all agree that it's workers themselves who bear the cost of employee health coverage. They bear the cost through reduced wages, they bear the cost through direct contributions. Health benefits are really just a form of non-cash compensation that's part of the worker's total compensation package. If the minimum compensation required is higher than workers are able to produce, they will be priced out of the market for labor. Thus, to deprive workers of these low-cost, limited benefit plans ultimately means that many workers will lose coverage. In the long run, many could lose their jobs. For example, by 2014, we estimate using CBO data that the minimum benefit level required for workers in medium to large firms will approach $5,000 per individual, or a little over $12,000 per family. If you break this down, this equals about $2 per hour for single coverage and nearly $6 an hour for family coverage. Add to that the required federal minimum wage of $7.25 in 2014, and you're getting up to the minimum cost to employ workers in medium to large firms at around $13 per hour, or $27,000 per year. Workers who cannot produce that much in value are at risk of finding themselves out of work. And besides, it would be a hardship to really expect workers with modest means to contribute sums of money equivalent to half their wages. The Affordable Care Act provides no new subsidies for low-income workers at large firms. A better way would be to have a uniform tax credit, as has been proposed by Senators Coburn and McCain. Let me conclude by saying plans that feature limited benefits in return for a lower monthly premium are not for everyone. Indeed, these plans cap benefits at a level that was never intended to provide protection in the event of a catastrophic medical illness. However, during the health care reform campaign debate, the President told the American people, and I quote, "And if you like your insurance plan, you will keep it. No one will be able to take that away from you," unquote. Many man plans provide a level of benefits that many Americans come to rely upon, and the loss of this coverage will make them worse off. Thank you.
Let me go to Dr. Herrick. You mentioned in your testimony, or in the written testimony, that Tennessee has a program called Cover 10 for families with incomes in between Medicaid and private coverage as a gap, and it provides a low-cost health insurance option capped at benefits with $25,000. And in that, you said that 98% of those employees don't reach that cap, which certainly is believable. Do you think that that is an affordable option, but would it meet the requirements of the new federal reform law, or would they have to significantly change their policies?
Oh, no, that would not meet the new requirements of the Affordable Care Act. The particular plan had a maximum benefit of $25,000, but of which no more than $15,000 could be used towards hospital care. And at the time, which was, I think, 2007, it was widely reported that Milliman, which is a benefits actuarial firm and consulting firm, reported that probably 98% of the enrollees would never reach their caps. High healthcare costs, high spenders tend to be concentrated among, older individuals, people on Medicare, and by and large, most of us don't really experience anything that's of a catastrophic nature in any given year. Of course, it is very tragic when it does occur, but I'm not sure if any health plan could affordably cover all risks.
The chairman mentioned that the state plans, or the state options, when they come into effect, are going to be run by the states and regulated by the states. But they do have the federal requirements, which is going to mean that they have to meet certain standards. I mean, even companies that provide, say, 35% of the premiums are not going to meet the federal standards. So doesn't that cut off a lot of plans that now give a level of coverage that maybe even a $25,000 limit coverage, but are not going to meet the federal plan, and so might be out of range of people who are now on these policies?
Oh, absolutely, and especially if you work for a medium-sized firm which employs more than 50 people. They get really no additional subsidy from the Affordable Care Act, and as I said, economists agree that workers themselves do bear the cost of coverage and reduced wages, and so a lot of people will be priced out of the market when their employer is required to provide a much higher level of coverage and then, of course, pass on the cost to them.
Thank you. My time is up. Thank you.
I'll go on, but I just want to make one correction. You are aware, are you not, Dr. Herrick, that in the health care plan that starting this year or next year, that 35% of health care premiums will be subsidized for small businesses? And that by 2014, 50%, up to 50% will be subsidized by federal premiums?
Yes, I'm aware of that. That's for very small firms, and it phases out as the average wage rises to $50,000. It phases out as the average number of employees reaches 25. And I can't recall the exact statistic, but it's been estimated that really a rather small proportion of small firms will, in fact, qualify for that program.